EPD, or Enterprise Products Partners, is the best company anyone can buy after the election of Donald Trump. They currently have a buy rating from the SA analysts, from Wall Street, and from the quant. And over the past 5 years, if we account for the price after the big drop in 2020, they are up by more than 150%, which is insane for a 5-year period. Now, if we jump to my stock valuation spreadsheets and plug in the ticker EPD, all the metrics will show up automatically. And as always, if you want to download these sheets, you can do so at the link in the description. We are currently running a 20% discount. Now, the first thing that captures my eye is the high dividend yield of the company, sitting at almost 6.5%, which is insane and is one of the reasons why many dividend investors are in love with EPD. Now, one thing that I don't like that much is their high trailing free cash flow payout ratio, sitting at 90%, which means that after paying out their dividends, they don't have that much free cash flow to push into innovation. But as the company is in the energy sector and they specialize mainly in transporting gas, they don't really have much innovation to do. So I don't mind EPD having such a high payout ratio as I would with some other companies. But let me show you something I do mind. If we jump to pillar 8 and scroll a little down, you can see that the free cash flow payout ratio in 2024 was sitting at 123%, which means that the company was essentially going into debt to just pay out dividends. Now, of course, like anyone, I love it when a company pays out dividends, but I love it even more when it's a smart financial decision. And to me, when the payout ratio is above 100%, it just doesn't make much sense. But let's jump to the 9-pillar analysis and have a closer look at the company. So when we have a look at the rating, you can see that they get a rating of 8 out of 9, which is a very decent score. Their 5-year PE ratio is sitting at only 11.69, and their 5-year price to free cash flow is sitting at 13.47, which means that over the past 5 years, the company has been trading very, very cheap. Investors have been underpaying for their earnings and for their free cash flow. And if I jump to pillar 1, their PE ratio is still sitting nice and low, so EPD is currently trading very, very cheap. Now, something I always say on this channel is that the stock price growth of a company is mainly based on their financial growth. So looking to their revenue, their 5-year revenue CAGR is sitting at 18.40%, free cash flow at 23.33%, and net income at 9.54%. Now, something worth mentioning is that the free cash flow of the company has actually been falling over the past 4 years, falling by about 40% from 2021. But what you have to understand is that the company's net income has been growing very well, and the company's revenue has been growing very, very well, growing by about 100% from 2020, from 27 billion to 56.6 billion in 2024. Something you also have to consider is that their return on invested capital has been growing very nicely and very steadily over the past 5 years, which basically tells me that they spend less to generate more profits. And these are the main reasons why I'm not too worried about the free cash flow falling a little over the past 5 years, as I do believe that it will start recovering. Now, jumping back to the 9-pillar analysis, let's have a look at the company's decreasing shares outstanding. They have been decreasing their shares outstanding at a very low rate, and the main reason for that is that they have a high trailing free cash flow payout ratio, which doesn't allow them to push more of their free cash flow into buying back shares. And the reason why this isn't great is that by buying back shares, a company essentially increases the value of the leftover shares outstanding, therefore increasing your investment. And now that we have gone through most of the pillars, let me point out one thing I really hate about the company, and that is their high debt. If we have a look at their long-term liabilities over their 5-year free cash flow negative dividends, it is sitting at 26.74. Now, even though they only have about $32 billion in long-term liabilities, which wouldn't be considered too much compared to the free cash flow they have been generating over the past 5 years, they do pay out most of their free cash flow in dividends. And therefore, while paying out their dividends and with the free cash flow they are currently generating, it would take them more than 100 years to pay off all their $32 billion in long-term liabilities. And that is something I really don't like about the company. Now, it doesn't mean that when a company has high debt that they cannot be considered a good investment. It just means that when they get into tough times, they could be more vulnerable, and therefore an investment into a company with high debt could be a bit more risky. But now that we have gone through the 9-pillar analysis, let's calculate the intrinsic value of EPD. So first, jumping to the Graham's formula revised, I will plug in the 5-year earnings growth estimate at 8.47% into the next 5 years plus. I will combine that with the 5-year earnings per share, the base PE, the growth rate multiplier, average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, and get an intrinsic value of $38.92, which is 16% higher than the current trading price. Now, for the next valuation model, we will look to the discounted cash flow model, which bases the intrinsic value on the future free cash flow of the company. So here we will take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 23.33%. But as we know, the free cash flow has been falling over the past 4 years, so I will predict the high growth at 7%, medium at 6%, and low at 5%, and this will give me a future growth rate of 6%. I will then use this to calculate the future free cash flow, and using a discount rate of 7.4%, I will calculate the present value of that future free cash flow. I will then sum all of that up, add cash and cash equivalents, and subtract total debt to get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $33.97, which is about 3% higher than the current trading price. Now, for the multiples valuation, I want to compare EPD to its biggest competitor, and that is Energy Transfer. I will take this company's current stock price, divide by their earnings per share, and get their PE ratio, which when multiplied by the earnings per share of EPD will give me an intrinsic value of $40.21. And now for the fourth and final valuation of this video, the dividend discount model, we will take the growth rate of the dividends over the past 5 years and calculate an average growth rate of 3.91%. Now, as the free cash flow payout ratio of the company is quite high, I will project the growth rate a little lower at only 2.33%, and when I combine that with the discount rate of 7.35%, I will get an intrinsic value of $42.81. And now finally, averaging out the 4 valuation models, we will get an ultimate intrinsic value of $38.98, which is almost 20% higher than the current trading price, and with a margin of safety of say 15%, we would get an acceptable buy price at $33.13. Now, with Trump elected as president and with his pro-gas politics, I would urge every investor to consider adding this growth gas transfer company to their portfolios. And with that, I hope that you enjoyed the video. I hope that you found it helpful, and make sure to leave a like and subscribe as it really helps me out.